Hello people, welcome to our new series on financial market. Today we will cover securities. What is security? Security is an financial instrument or contract which shows the evidence of either indebtedness or a proportional share of ownership, like shares, debentures, loan, bonds, etc. These bonds are issued by people who are in need of money. And similarly, there are people who want to invest their surplus, are the investors which invest in these securities. The investors can be institutional or retail. Retail investors are are investors which invest in small amounts, whereas institutional investors are those investors which invest in huge amounts. So let's start our journey of understanding securities and various types of securities. Our first security will be equity share. Equity share represents a form of fractional ownership in business venture. Equity shareholders collectively own the company. Actually, what we have done is that the entire cost of making company is divided into small units called shares, and a person holds shares, and his proportional share means what he must own out of total number of shares is the percentage of ownership of that man. For example, a company issued 100 shares and a man purchased 10 shares. Then a man is 10% owner of that company. These shares are issued by companies, and both retail and institutional investors invest in these companies. The issue of equity shares is regulated by SEBI, that is Stock Exchange Board of India, and regulator under the Companies Act. These can be issued directly by the company or it is issued through stock exchange. Let's come to other security, that is debenture. What is a debenture? Debenture is a long-term loan agreement of company in which a company has taken a long-term loan from an institute or a retail investors. These are issued by companies, special purpose vehicle, as well as government. Debentures bonds are regulated by SEBI, RBI, and regulator under Companies Act. These are long term in nature and these can be secured as well as unsecured. Secured debentures are those debentures who have collateral, or you can say an asset is charged on them. That in case if a company default or is not in a condition to repay the money to the investor, then the particular assets of the company will be sold out. Whereas in unsecured debentures, there are no charge on assets of company. The asset, the investor will be treated as an unsecured lender who had lended money to the company. There is no particular charge on an asset. Debentures can be fully convertible debentures, partly convertible debentures, or non-convertible debentures. Fully convertible debentures are those debentures which can be converted into equity shares on date of maturity. Partially convertible debentures are those debentures which can be partially converted into the equity shares of company. The ratio will be given at the time of issue of debenture. The ratio, time, amount, all conditions will be available in the prospectus where the company issues debenture. Non-convertible debenture. These debentures are debentures which does not be converted into equity shares. At the time of redemption, the company will pay the amount in full to the company, to the investor, and the investor will get the interest i- during the life of debenture. You have often heard about 14% debentures. That means that a debenture will give 14% interest on the amount or on the face value of debenture. Let's come to other topic, that is external debt sources. That is when a company takes debt in a foreign currency or from foreign market. These are foreign currency bonds. The bonds which are issued in other country, that is domestic country, in the foreign or in the domestic currency of the place where bonds are issued. Foreign currency bonds are such bonds. External bonds, euro bonds, masala bonds. External bonds are the same that bonds which are issued outside the country in the domination of that country. For example, if an Indian company is going to US to take bond or to take debenture in a dollar terms, that is called external bond. Euro bond will be a bond which will be issued in a country, which will be issued in a foreign country in a domestic currency. For example, an Indian company going to America to take loan in rupee term, not in dollar term, then it will be termed as euro bond. Or masala bond is a specific for India, that when an Indian company goes to America, takes loan in rupee terms, that is called masala bond. And euro bond is a general term. It, in other words, it means that the masala bond is a part of euro bond. Foreign currency convertible bond. Foreign currency convertible bonds are bonds which are converted into the the shares of an issuing company on the date of maturity, just like a convertible debentures, but the only difference is that this is issued in overseas territory in a foreign currency or in a currency other than a domestic currency. Foreign currency exchangeable bond. In foreign currency exchangeable bond, the bond are issued by a company in a foreign territory in a foreign currency, but these bonds are converted into the shares of a particular company. It means that it is not converted into the shares of an issuing company, but a share of another company. There is also a precondition that while issuing a foreign currency exchangeable bond, the issuer must hold the shares of the particular company whom it can be converted at the time of maturity. Warrants and convertible warrants. Warrants and options that entitle an investor to buy shares of the issuer after a specified time period at a predetermined price. Shares warrants are gives the gives the option to the investor that he can convert his warrants into a share at a particular price, which is generally lower than the market price of share. Mutual fund. A mutual fund is an investment vehicle which pools the fund from various sources like individual, institutional, retail investors, and invest that money into a wide range of assets to generate maximum possible return. A mutual fund is an investment vehicle that pools money from several investors to invest in a mix of assets like stock, bonds, government securities, and even gold. The mutual funds can be open-ended or closed-ended. Open-ended funds are those funds which do not have maturity. At any point of time, new securities are created or new units are created and old units can be cancelled off. Whereas closed-ended mutual funds are those funds which have a fixed time period and the units are issued at NFO, that means new fund offer, and there will be no creation of any unit after the new fund offer. That is the difference between open-ended mutual fund and closed-ended mutual fund. These are basically types of mutual fund. Exchange traded fund. An exchange traded fund is an investment fund that holds multiple assets that can be bought and sold on exchange. It is also like a mutual fund, but it is a fund that tracks a index. There is an index like Sensex, Nifty 50. These are the indexes which exchange traded fund tracks. These funds are passively managed and have very low maintenance costs. An exchange traded fund tracks amount of an underlying asset. For example, Sensex, Nifty 50, gold and other funds. A preference share. Shares are of two types, equity shares and preference shares. Equity shares are the real owners and they have a residual rights after the payment of all the other stakeholders. Whereas a preference share is a special kind of share which has a preference over common and ordinary equity. Shares at the time of dividend and repayment of capital. That means that the dividend is fixed here. Just like debentures, they are also issued as 12% preference shares. That means that the preference shareholder has a right of 12% return. These shareholders do not have voting right, but they have a preference when the dividends are distributed and at a time of repayment of capital. That without paying the capital to or without repayment of capital to preference shareholders, the dues of equity shareholders will not be entertained or will not be dealt with. IDR, GDR, ADR. IDR stands for Indian Depository Receipts. GDR is Global Depository Receipt. ADR is American Depository Receipt. Depository receipts are financial instrument that represents a share of a foreign company. That means that if an Indian company wants to issue shares in America, then there is a one option to get it listed through NASDAQ, which is a complicated process. But without going through that process, an Indian company can go to a bank and surrenders its share, and the bank will issue a certificate. That certificate will be given to a custodian and that custodian will issue share. That will reduce the complication of getting listed in a NASDAQ or a foreign stock market. Depository receipts are of sponsored depository receipts and unsponsored depository receipts. Sponsored depository receipts are those which are converted by the companies, whereas unsponsored depository receipts are those receipts which are converted by the individual investors or shareholder. They have also two-way fungibility. That is, that depository receipt can be converted into shares and shares can be converted into depository receipt. So therefore, these are the financial instrument that represent shares of a foreign company. And here is our last topic, that is REITs and invites. REITs are the real estate investment trust and invites are the infrastructure investment trust. These are the financial instruments that helps to pool money from various investors and invest in revenue generating activity of real estate projects and infrastructure projects. Basically, these types of trusts gather money from a variety of investors and then they invest in a construction of a infrastructure or a real estate project. The returns from the real estate project and the infrastructure projects will be given to the holders of in such shares of trustee or units of trustee. That helps an individual investor to gain from the rise in price or the appreciation of assets, whereas it helps the issuer to diversify their sources of funds. And REITs and invites are required to distribute 90% of their surplus to the holders of REITs and invites, that is real estate infrastructure trust and infrastructure investment trust. And thank you here. And here we end this first lecture or a first part of securities. First part, securities of financial market. Thank you.